It's time to check your money with your friendly neighborhood advisor. Mike Jennings is a wealth advisor with Bracken's Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC. The first question I have for you, my dear Michael, is did you get up on time this morning?
I uh I didn't. I usually don't. So that wasn't a big surprise.
Okay, well, I mean, you do know that we turned our clocks back, and so you're here now, but it is daylight, the end of daylight savings time, the beginning of Eastern time. I mean, the beginning or return to standard time. Just want to
There
make
we
sure
go. There we
you
go.
did that. You did that, right? So whatever it is, you still slept through it, didn't you?
Whether it was an hour forward, hour back, I'm still in the
Okay.
bed.
All right. What's going on?
Yep. So this week I just wanted to come on really quickly. There's been a lot of things going on. I just wanted to sort of give a quick summary of some of the changes that we've seen with the whole student loan repayment situation that many Americans are facing. So, whether you're actively paying down your debt or you've been in forbearance, these changes, these shifts could affect your monthly cash flow, your repayment timeline, whatever the case may be. And obviously, of course, your financial planning overall.
Mm-hmm.
So this is obviously a very important topic. So I just wanted to come in really quickly and go through some of the or summarize some of these changes. Is that good with you, George?
That's good with me.
All right, so some months back, we talked about the resumed collection activities on defaulted federal student loans. Borrowers in the SAVE plan, which is the income-driven repayment option that was introduced a few years back during Biden's term.
Mm-hmm.
They have seen their interest being accrued again as of August 1st. So if you are in that repayment plan that was paused or non-accrual in a non-accrual state, your interest total has likely started growing again and will be added to your balance at a certain point. Unfortunately, some of the more aggressive approaches that the administration was talking about, like wage garnishment, haven't been reported as starting as of yet. So
Mm-hmm.
we can at least take a little breath there. But just recently, there was a
Well, that's
deal
if you don't
made.
pay, right? I mean,
That,
obviously, if you don't pay,
that's
yeah, yeah,
that's
yeah.
it. Exactly,
Okay,
exactly.
okay.
But I guess in bigger news, just recently there was a deal made between the or with the Trump administration for borrowers on two specific repayment plans. I hope I get these. Hope I get these these initialisms right. So the pay as you earn plan, or PAYE pay, and the income contingent repayment plan, ICR plan. So those are the two plans that will be eligible for forgiveness for a certain window of time. So if you have satisfied the forgiveness terms on either one of those plans or will in the next couple years, then you can have your loans forgiven up until July 1st, 2028.
Mm.
If you haven't satisfied those terms, forgiveness terms, then you can still remain on those plans and switch to the new standard plan or repayment assistant plan before July 1st, 2028, and still have those payments that you'll be doing in the next couple years count and be credited towards forgiveness. Now, current borrowers who don't switch to the defaulted, who don't switch to another plan, they will be defaulted to the repayment assistant plan (RAP). And it's going to be a bunch of acronyms all over the place. And that plan has an increased 30-year time frame for forgiveness compared to the 20 and 25-year windows that we've seen with the other plans. So that again, a bit of relief for those who are expecting forgiveness in the next few years. But it definitely should be noted that borrowers should keep records of the payments that they have made, just to make sure they don't lose any qualifying months, just to make sure that, nobody in the future can come back and say, hey, you didn't make the payments and everything. This is a very convoluted process going on. Taking all the repayment plans and chopping them down to two because of of course, the one big beautiful bill. So it'll definitely be a little messy for a lot of people. So, in summary, pretty much after July 1st, 2028, there will be only two repayment options. So that is the standard repayment plan, which is a 10-year plan. It takes your balance and splits it over 10 years. And that's for plans that are or current borrowers who have loans that start before July 1st, 2026. Now, for loans that are started after July 2026, there is a stratified repayment window. So for those who have borrowed up to 24,999, so just under 25,000, will still have a 10-year repayment term. Those who owe between 25,000 and 50,000 pretty much will pay back their debt over 15 years. From 50,000 to 100,000, it will be over 20 years, and anything over 100,000 borrowed will be paid back over the 25-year plan. And again, the new repayment assistant plan is again, that's forgiveness after 30 years of paying back your loans. So still a much longer time than some of the earlier plans, but if that's what you're hoping for, forgiveness, then that's the rules of the game you have to play by. So, how does this relate to the listeners out there? How does it, how can it affect your financial planning, right? So, of course, your monthly cash flow, if your payment goes up, you have less to put towards the other things that you're saving for, your emergency savings, your mortgage, your retirement, everything. So you have to budget accordingly. Interest and balance growth. So obviously, as interest resumes, your balance may grow to even bigger than what it is now, and you have to make payments on that bigger balance, which means more cost over time, right? Just like, if you pay the minimum on your credit card, you have to pay more over time because of
Right.
interest. Same deal here. Forgiveness, I mean, I just laid out all those terms, but who knows what happens with the next administration? Who knows what happens 10 years from now? Who knows what the courts will say? So I guess it is still uncertain, and obviously it is further out now. So if you are counting on that, obviously keep doing what you're doing now, just so that you can still get those payments credited, but be wary that clearly these things can change at any given moment. Um, Credit and default risk. So, being in default or delinquent doesn't just obviously impact your student loan status, it affects your credit score. We talked about that a lot with some of our conversations around credit and credit cards and things like that. New borrowing decisions, right? So for students and parents who are, still coming up on students starting at college and needing these loans to get to afford school, you have to think about this little window that we have here in the next couple years, and also even after that. So again, these things can change. There's a lot of important deadlines and timelines that we have to pay attention to. So if that is you, if this is a situation, whether you're going back to school or you're sending kids off to school in the next couple of years, pay attention to these deadlines and if and how they may change in the near future. Also, another big thing is taxes. So student loan forgiveness, except under certain programs like the public service loan forgiveness program, is generally taxable. Forgiveness is seen as taxable income. So that could be a major tax bomb for people that are not expecting that, for people that didn't know that
So
to be a
you're
fact.
if you got your loan forgiven, then
Right.
let's say it was 60,000, then
hmm
you have to include that as income.
That will be income in the year that it is forgiven. So forgiveness, quote unquote, isn't necessarily forgiveness. It just
So
means,
basically, you're going to be taxed on the forgiveness.
yep. So
Wow.
if you make 20,000 a year and that's your taxable income in 2038 and you get your loans forgiven in 2038, you're 60,000, then that means in 2038 you have $80,000 or up to $80,000
Of income.
of income. Yep. It's stratified, but a large portion of that can
Was that
be.
always the case, or is that what the case is now?
Yes, again, for most sort of loan forgiveness things, think of it similar to like use a loan consolidation, right?
Right.
It's you're taking money from somewhere and you're putting it towards something. So with loan forgiveness for things outside of those specific like PSLF, think of it as money taken from income to
Right.
pay for that the federal government income, right? So. a big thing to pay attention to. And that could basically just put you in the same spot in a different place.
Right.
Instead of owing student loans, you now might own tax that you can't pay back and have to be on a repayment schedule
Right. And now you
for
got a
that.
problem with the IRS.
Exactly. You're out of the frying pan and into the fire. So now you're talking to the IRS, which is they're a lot less forgiving.
Forgiving.
Forgiving. Yes, that's the word I was looking for. Um, so obviously these are a lot of things to pay attention to. These are a lot of things that can affect you in many different ways. So of course, if you are if this concerns you, if you are worried about this, if this affects you or someone that you care about, give your friendly neighborhood advisor a call at 315-748-5540. Again, that's 315-748-5540. Or give me a quick call or send me a quick note at michael.jennings@brackensfsn.com.
Mike Jennings is a wealth advisor with Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC. He is your friendly neighborhood advisor.